So many investors are now on full-on panic mode as they watch markets melt down. So what is actually happening? Let's break it down in this video, and what should we do rationally as investors? So I can see around me, and you can see around you, that more and more investors are getting into real panic mode right now because it seems that many markets are beginning to melt down at the same time. Beginning, of course, with the US market. So the S&P 500 is down. Let's check it out. It's down about from the peak on the 15th of July. You can see it's down all the way about 6%, and futures look like it could be going a lot lower today. Down 6% on the S&P 500. For the NASDAQ, the tech-heavy NASDAQ, of course, we've got a much bigger decline, down about all the way down about 11%. And it's not just US markets. So, Japan really got hit, especially today. If we look at the Japanese market, the Nikkei 225, the Nikkei 225 has dropped over 25% from the peak. Look at that big red candle. Not just equity markets, but crypto, which, as you guys know, I don't buy, but I like to look at it purely for entertainment purposes. We look at a Bitcoin today. Bitcoin's also down quite a bit. So what's going on? What's creating this global meltdown, not just in equities, but in all kinds of assets? Let's break it down. And what should we do about it? Now, I don't know whether I'm weird, but I'm one of the few people that whenever I see these big red candles and the crash and people panicking, I get really turned on. Right? And I start buying. In fact, I couldn't help myself. Today in the Asian markets, I started buying some of the Singapore bank shares because I've been waiting all year to buy the Singapore bank shares, but they wouldn't come down. So at last, like I said, you got to be patient, never chase the girl, wait, the girl will eventually run into your arms. Now, I already have a lot of Singapore bank shares that I bought many years ago, but I always want to keep adding every single year to build the position, right? So DBS, which is listed in Singapore, you can see that at last it dropped to my first buy level today, so I started buying my first tranche. Every year, I allocate a certain amount of cash to buy my favorite stocks. And I never buy all at once. I buy in 3 to 4 tranches at 3 to 4 support levels. So you can see DBS, it hit my first support level. So I bought my first 1/4 tranche for this year's allocation. And I'm a weird guy. Every time I buy something, I hope it goes a lot lower. Right? So I'm hoping if it goes to the second support level, I'm going to buy more at the second support, drops to third, I buy even more. And if it drops all the way down, then, I go all in, baby, right? But most of the time, it won't drop to the fourth level all the time. Normally, after the first or second level, it will start to rebound back up. So we'll see how it goes. I also began adding to UOB, which hit the second support level today, actually. U11. Yep. And I send the alert to all my UIP subscribers. You can see that's the fair value, and that's the first support. And I didn't buy the first support because I was waiting for UOB to hit second support right there, started adding to UOB shares. So again, taking advantage of this meltdown wherever I can. And when US markets open tonight, I could be going on a buying spree as well. But again, not going all in because it could go a lot lower in the short term before it eventually rebounds back up. So why are markets going down? Well, the first reason is because what goes up must come down. I've said many times before that the markets don't go up in a straight line. Even in a bull market, it doesn't go up in a straight line. It goes through, you got it, wave patterns. After wave up, you gotta have a wave down. It's just that no one knows exactly when the wave down happens and how long it lasts, but it will wave down. And after the wave down, there'll be another wave up. So I've already said many times in my previous videos that if you look at the markets, right, a wave up, wave down, wave up, wave down, wave up, wave down, wave up. I said a wave down is coming. Wave down is coming. When? I don't know when. It will come one day, and sure enough, now it's come. That's your wave down, okay? So when you know it's going to happen, you expect it. You don't worry about it when it happens. You don't get upset. It's part of the journey. It's just part of the game, and you take advantage of it, right? Now remember that in any given year, statistically, the market will drop at least 5% 3 times a year on average. And by the way, so far this year, the market has only dropped twice. This is the second time. So based on a quota, we may get another one before the end of the year. So it's part of the journey, it's part of the game. It's not unexpected, right? And out of the 3 declines that happen every year on average, one of those declines will be at least 10% or more. And so far for the S&P 500, has it dropped 10% or more? Not yet. It's only down 6%. So like I said, I'm not surprised if we go down another 4 to 5%, because we need to drop at least 10% once a year based on this quarter, right? And about once every 3 years, the market, the S&P, will drop 15% or more. So could this be one of the 3 years? No, maybe, all right? And once every 6 years, the market will drop 20% or more. That's called a bear market on average. Could this be a bear market this year? Well, everything is possible, especially if there's a recession, but I doubt it for now, all right, for a few reasons. Number one, I think that while the unemployment rate has been going up and the jobs being added was less than expected, there are other areas of the economy that's showing a lot of strength. Okay, so it's still not 100% clear that the US economy will go into recession this year. That's number one. Number two, we already had a bear market in 2020 and another bear market in 2022. So we already had 2 bear markets in the last 5 years, which is incredibly rare. So for us to have another bear market this year could happen, but is bloody rare if it happens, right? So for now, I think it's unlikely. Now, there are always catalysts or always reasons that give investors an excuse to panic and to sell and to take profit and to cut loss, and to give market manipulators and algos and market makers a good reason to manipulate the markets down. So in this case, what are the catalysts? The reasons that triggered this sell-off? Well, there are 4 catalysts. Let's look at them one by one. And let's ask this question. Are they short-term problems or long-term problems? Should we be afraid of it or should we take advantage of it? So the first catalyst is a sudden fear that the US economy could be going into recession, that the Fed that said they're cutting rates in September could be cutting too late. And by the time they cut, it's too late. The US economy has weakened too much. We go into recession. So that is the fear. And one of the things that triggered the fear was that US employment figures came in lighter than expected. The markets were expecting 175,000 jobs being created in July, but instead only 117 jobs were created. So that's one thing. The second thing was the trigger of what is called the SAM rule. I'm not sure how you pronounce it. It's called the SAM rule or the SAM rule, or whatever it is, right? So basically, the SAM rule indicator identifies a recession when the 3-month moving average of the unemployment rate rises at least 0.5% from the low in the previous 12 months. Right? And recently, that's what happened. The unemployment rate went up to 4.3%, which is more than 0.5% above the 12-month low, triggering this indicator, which historically has so-called predicted or indicated that a recession is coming. So how much weight should we put into these economic indicators? Well, here's the thing. There are many indicators that so-called predict recessions, like the yield curve inversion and unemployment rate, and there are so many, right? And if you look back at history, even the top economists in the world using all these indicators can't predict a recession consistently. Like almost every economist predicted a recession in 2023 because of the yield curve inversion, because of many other indicators. It didn't happen. So I'm not saying that this indicator is wrong now. I'm not saying that I don't know. But the point is that no indicator can magically predict recessions. Okay, so just bear it in mind. But I think it's really important to ask the person who invented this indicator what he or she thinks. So that's what they did. So when this indicator triggered this prediction, they asked Claudia Sam, who is the inventor of this indicator, hey, what do you think? Do you think it's really going to be a recession? And she said, no, I don't think it's real this time. What? Okay, so these were actually her words. She said, I'm not concerned that at this moment we are in a recession. No one should panic today. Some noted that household income is still growing, while consumer spending and business investments remain resilient. So these are key measures of the economy that still look really good. This time really could be different, she says. the rule that she invented may not tell us what's told in the past because of these swings from labor shortages, with people dropping out of the labor force to now having immigrants coming lately. This all can show up in changes in the unemployment rate, which is the core of the sum rule. So what she's saying is that, yeah, my indicator is showing a rise in unemployment rate, which historically shows a possible recession, but there are other economic indicators that are very strong, like a stronger than expected US GDP growth, consumer spending strong. So my indicator, may not work this time. And it's coming from the person who created the indicator. And what she's also saying is that because of the change of immigration policy, stuff like that, that is kind of like distorting her rule. All right. Now, in addition, Ed Yardeni, that runs Yardeni Research, he said something pretty interesting. He said that recently the employment numbers were distorted because of the Beryl hurricane that hit the south of the US in July, like Florida, like Texas, where because of the bad weather, people, couldn't get employment, they couldn't work. And how many people were affected? Specifically, 1.5 million were affected by weather-impacted employment. So what Ed Yardeni is saying that this distorted the figures in July, and next month we should have a strong rebound. So is that 100% correct? Is she 100% correct? No one knows. But again, something to think about. So whenever you're making decisions, don't just look at one part of it, look at the other part of it, right? So that's one thing. Okay. Now, even if the indicator is accurate and we are going to get a recession, for example, okay, then is this indicator a good tool to time the market, to time the buy or to time the sell? In this case, should we use this indicator that it's time to sell? That's a good question, right? Well, if you look at history, this is the S&P 500, and the blue dot were all the times the sum indicator was triggered. Okay, so in the past, every time you saw this indicator and you sold, would you have made the right decision? Well, you can look at certain times and say, well, yes, for example, during the .com crash, if you saw this indicator and you sold, and after you sold, it went down, you would think, yay, good, right? Good to listen to the indicator. Same thing in the financial crisis. We got the trigger of the indicator. If you saw that you sold, you could also have saved yourself that big drop. So notice that whatever indicator you use, the sum indicator, Fibonacci, stochastics, MACD, Ichimoku cloud, Ichi backside, whatever indicator works sometimes, but it never works all the time. That's the problem, right? Because if you had followed this indicator, you would have sold right here. You would have sold right at the bottom of the COVID crash. And by selling here or shorting the market, you would have missed out on the huge bull market here and the huge bull market here. Can you see that? At the same time, you can go back to history and look at this same thing, right? All right, after the market drop here, we've got the sum indicator being triggered. And if you said, oh my God, sum is here, sell. Oh no, right? Same thing here, right? Sum indicator sell. Sum indicator sell. But sometimes it works, right? Like sometimes some indicator sell, drops a bit, yay, but goes up, oh shit. Okay, so like I said, no indicator works all the time. And that's why for me, I never use any of these indicators to so-called try to time the market to get out or get back in. Because in the long run, you find that by doing that, in the long run, it would reduce your performance in the market by trying to jump in and jump out. Okay, so something to think about. Now, the second thing that is spooking the markets is political uncertainty. And it's really interesting. Now, I'm not an American, so when I look at American politics, I get really intrigued because just a week ago, it was a foregone conclusion that Trump would win, right? Everyone was voting for Trump and Biden was like gone, and the Democrats were weeping, it's over for them, and they don't know what to do, right? Because Biden would not drop out, and even if he did, who would replace him? Because Kamala Harris, at the time, everyone thought that she was a weak vice president, that she had a very high unfavorability rating, and then suddenly overnight, everything changed. Biden dropped out, and now Kamala Harris is like the next big thing. Everyone is loving her. She's getting all these massive volunteers and fans, and now it looks like she's gonna win. So it's amazing. Like, 1 week, everything changes, okay? And the thing is that markets don't like uncertainty. They don't like it. So when it was certain that Trump would win, the markets were like, all right, that's great, right? Because Trump is going to cut taxes, cut corporate taxes, deregulate the economy. But now he may not win. Kamala may win. So uncertainty, market goes down. So is it something we should be concerned about? I don't think so, right? So it's really interesting because if you talk to Republicans, they'll tell you that, if the Democrats win, is the end of the world. We're all going to die. If you ask the Democrats, they say that if Republicans win, we're all going to die. Okay, so someone has to win, right? It's like saying that, if you don't believe in my God, you're going to hell. But if everyone says that, then, where are we going to go, right? So the Christians say if you don't believe in Jesus, you're going to go to hell. The Muslims say don't believe in Allah, you're going to go to hell. So who's going to hell? I don't know. Okay, but if you look at the facts show that at the end of the day, the market doesn't like uncertainty. But once there's certainty, once there's a winner in the election, the market goes up, regardless of who wins, regardless of the Republicans or the Democrats. And in the long run, should we be concerned about who's in the White House? No. Because in the long run, you can see that whether it's a Democratic president or Republican president, in the long run, the stock market will always go up. In fact, statistically, if you look at history, you can see that Democratic presidents, when they are in charge, the stock market has a median annual return of 12.9% a year. Whereas when Republicans are in charge, the stock market has a median annual return of 9.9%. So if history is anything to go by, Kamala Harris should actually be better for the stock markets than Trump. Again, we can't predict the future, but look at the numbers don't lie. Okay. The third thing that could be freaking out the markets is a sudden escalation of the Middle East crisis yet again. It's like never ending, right? So everything was quiet, and then suddenly Israel went to kill some Hamas commanders, and Hamas going to strike back, and Iran's going to strike back, going to have a bigger war, and and then panic again, right? And that explains why recently the defense stocks like Lockheed Martin that manufactures the F-16 planes and Raytheon, the stocks all went up because of the Middle East crisis. Because whenever there's a war crisis, who makes a lot of money? The defense companies. So there's an old saying, if there was no money to be made in war, there'll be no more wars. So at the end of the day, why are wars there? Because there's money to be made in wars. Sad fact, but it's absolutely true, right? Should we be concerned about this war? Again, you got to ask yourself this question. Is this a short-term thing? Or is this a long-term thing? And the answer is all these are short-term issues because every war will end and then another one will start, right? Every political conflict will start and will end again. And at the end of the day, ask yourself, the companies that you own, especially if you own high quality companies like me, I own your Microsofts, your Amazons, your Nvidias, your Google and all that, right? Will all these wars really affect the profits of these companies? No, right? The share price drops, it's all emotional, it's all sentiment, but the actual business itself, it's the same business. They're still making a lot of money. They're still growing their free cash flow. Their intrinsic values are rising. People still eating McDonald's. People are still eating Domino's Pizza. People are still spending money over the long run, right? And again, if you look at history, you notice that there are always going to be wars. Whether is it World War I or World War II or the Arab-Israel War, Korean War, Vietnam War. Again, notice how many Arab-Israel wars there are. There's always one every few years. It's kind of like a new season of some game show, right? You've got, Gulf War, Afghan War, Iraq War, Syria War, Kosovo, Russia, Ukraine, whatever, right? There are always going to be wars. And all these wars may cause the market to drop temporarily, but at the end, the market always goes higher. So use this as an opportunity to grab good companies at low prices. Not that we want wars to happen, but since they're happening anyway, why not take advantage of how it affects the markets? Okay. The fourth thing, or the fourth catalyst that's causing the market meltdown, is the unwinding of the yen carry trade. Now, what the heck does that mean? Now, it's playing a big impact in the markets, and I believe it is also causing the crash in cryptocurrencies. So let me explain what it is. Now, so for many, many years, the Japanese yen, the interest rate on the Japanese yen is very low. Very, very low. It's like close to zero, right? So many traders around the world, what they do is they borrow money from Japan at near zero interest rates, right? They borrow in yen. And once they borrow the money in yen, what do? They convert it to other currencies like US dollar or whatever, and they buy maybe US bonds that gives higher interest rates than Japanese bonds, right? Or they buy US stocks, they use it to buy crypto, they use it to buy all kinds of shit, right? And for years, this worked really well because it's like you're borrowing money for free and using the free money to buy stuff that gives you huge returns. Makes a lot of sense, right? Except recently, something happened that are killing all these traders that borrowed yen to buy stuff, okay? So recently, because of the need to control inflation, the Bank of Japan started to increase interest rates. And they have signaled that they will continue to increase interest rates. So when a Bank of Japan increases interest rates, what happens? The Japanese yen goes up. So you can see over here, this is the Japanese yen versus the US dollar. Whoa! Right? It's a big spike. Okay? Now, if you turn the chart the other way around, since the yen is appreciating against the US dollar, conversely, the US dollar versus the yen is collapsing. Can you see? So imagine all the people who borrowed money in yen, converted to US dollars and bought US dollar assets like crypto and US stocks. Now they are in big shit. They are in big shit. Why? Because now the US dollar depreciate against the yen that they borrowed. So now if they take the US dollars, convert back to yen, they get a lot less yen and may not be enough yen to pay back their loans in yen. At the same time, the interest rate in Japan gone up, so it makes their returns go down since they have to pay interest in yen, right? So these guys are now seeing that they're going to lose a lot of money, especially that the Bank of Japan will continue to raise rates. They thought, oh, we are fucked, okay? So they're panicking now, oh my God. So they're all unwinding their trades. So to unwind their trades, what are they doing? They are being forced to sell their US stocks. Or sell their Singapore stocks, or sell their crypto, okay, to get back their money, to convert back to yen and to pay back their yen loans. That's why you're seeing all these forced selling, these forced liquidations, causing these market prices to crash. And as the market crashes more, people get more margin calls and they get forced to sell. That creates more selling, and you just keep going down and down and down. Of course, market makers jump in to manipulate the markets even lower to squeeze out the weak hands, so force them to sell some more. And it will just keep going down until we have what we call capitulation. Capitulation is when the retail investor gives up and surrenders and they sell in panic, and that's when it bottoms. And has it bottomed yet? No. I think it will still go a bit more lower than this, but the exact bottom no one can predict, right?